Welcome back to the Deep Dive. It is January 2026, and today we're attempting a bit of a balancing act.
This should be interesting.
We're trying to understand the health of an entire national economy, specifically India's engineering engine, by looking at two completely different ends of the spectrum.
It's the classic macro versus micro challenge, isn't it? The forest and the trees.
Exactly. On one hand, we've got this massive high-level view. The Engineering Export Promotion Council, the EEPC, report for the start of the 2025-26 fiscal year.
Billions of dollars, global geopolitics, trade wars.
The whole nine yards. And on the other hand, we have a single prospectus. A small company called Shayona Engineering Ltd. Out of Vadodara, Gujarat, opening its IPO literally this week.
And the mission here, I take it, is to see if those two worlds actually talk to each other.
That's it.
Does the huge export data we see in the headlines actually translate to the shop floor of a small manufacturer in Western India? Or are they just, operating in parallel universes?
I think that is the perfect way to frame it. So let's start with the forest, the EEPC report. Because I was reading through this, and the headline number for April 2025, which kicked off this fiscal year, it's aggressive.
It is.
Engineering exports hit $9.51 billion in a single month.
Which is a very strong start. To put that in context for you, that's an 11.28% jump compared to the same time last year.
Okay, but you had to contextualize that growth, right?
Yeah.
It's easy to show growth if you're coming off a bad year.
But we aren't. That's the key. The previous fiscal year, 2024-25, was an all-time record breaker. India shipped $116.7 billion worth of engineering goods.
So we are stacking growth on top of a record high.
Exactly.
This isn't a recovery bounce, it's sustained acceleration.
Precisely. It signals that Indian engineering has moved past the whole recovery phase and is now in a genuine expansion. The momentum is real, and when you dig into what is being sold, that narrative gets even stronger.
I was looking at that breakdown. Usually when I hear engineering exports, my mind goes to, nuts, bolts, maybe some car parts.
Sure, the basics.
And those are there. But the growth drivers listed here are heavyweights: electrical machinery, motor vehicles, cars. But there was one category that just made me do a double take. Ships, boats, and floating structures.
You saw that massive percentage jump.
I did. A 92% growth year on year. That is not a rounding error. That's almost doubling what is happening there.
It's a sign of significant maturity in the sector. I mean, you don't build ships overnight, and you certainly don't scale ship exports by accident.
No.
This suggests India is moving up the value chain into heavy, complex assembly. We're not just making the components anymore, we're making the finished, high-value assets.
That is fascinating. It's like graduating from making the bricks to actually building the house.
That's a great analogy. And speaking of bricks, or maybe the beams that hold the house up, we have to talk about the recovery in iron and steel.
Yeah.
That sector had been in the red for months, dragging the whole index down. In this April data set, it finally flipped back to positive.
Which is a leading indicator, isn't it? Steel is the feedstock for everything else. If steel is moving, it means the factories are hungry.
Exactly. If steel is stagnant, it usually means manufacturing is slowing down. When steel exports pick up, it means global construction and manufacturing demand is, it's waking up. It's the pulse of the industrial world.
Speaking of demand, who is buying all this stuff?
Yeah.
Because the geopolitical map in this report, it looks very different than it did 5 years ago.
This is crucial for anyone watching global trade. The United States remains the absolute king of consumption for Indian engineering. They're the #1 destination, holding a massive 21.1% share of our total engineering exports.
So nearly a fifth of everything we make goes to America.
And specifically, exports to the USA grew by 17.2%.
Wow. That's a huge dependency, but also a huge opportunity.
It is. It shows that despite all the talk of protectionism, or America first, the U.S. supply chain is still deeply integrated with India. But the real story in this report, the one that I think hints at the future, is diversification. You have to look at the global south.
I saw that. The numbers for the emerging markets were just jumping off the page.
Right. Exports to sub-Saharan Africa are up 31.6%.
31%.
Latin America is up 27.2%. Oceania, which is mostly Australia and New Zealand, up 36.4%.
That feels strategic. It feels like hedging. If the U.S. or Europe catches a cold, we have these other engines running in Africa and South America.
It is the definition of a diversified portfolio. And you need that hedge because the report shows that the traditional engines outside of the U.S.
They're sputtering.
Exactly, they're sputtering. We have to talk about the elephant in the room.
China.
China. Exports to China collapsed down 21.7%.
That is a cliff. Is that just a slowing Chinese economy, or is that political?
It's likely a combination of both. China is aggressively localizing its own manufacturing, their dual circulation strategy. They want to import less and make more.
Right.
Plus, their own internal demand has been soft. And Europe is looking shaky too. Italy and Turkey both posted double-digit declines, so if India was relying solely on China and Europe, this report would look like a disaster.
The fact that the overall number is up 11% despite China crashing tells you just how strong that U.S. and emerging market demand really is.
Exactly. It shows resilience. But, and there is always a but, in macroeconomics, there was one specific detail in the report that felt like a bit of a warning shot. It mentioned Section 232 tariffs.
Yes, I circled that. Section 232. It sounds like boring legalese, but the report blames it specifically for the decline in aluminum products. Can we unpack that?
We definitely should. So, Section 232 of the Trade Expansion Act lets the U.S. president impose tariffs on imports if they're seen as a threat to national security.
Okay.
It was a big deal a few years ago, and the report notes it's been reinstated, or at least reinforced, regarding aluminum.
So the U.S. puts a tax on foreign aluminum to protect its own smelters.
Correct, and that creates a domino effect. The report explicitly mentions South Korea here. South Korea exports a lot of finished goods to the U.S., but because the U.S. slapped tariffs on them, or retaliatory measures kicked in, South Korea is exporting less.
So since they're making less, they need less raw aluminum from India.
Exactly. India gets hit twice. Directly by the tariffs if we sell to the U.S., and indirectly because our other customers, like South Korea, are getting hit.
It's a complex web. It reminds us that while that $9.5 billion number is great, it's fragile. It's subject to the whim of a signature in Washington or a policy change in Beijing.
These export numbers just don't exist in a vacuum.
And the report underscores just how high the stakes are for the domestic economy.
Yeah.
I saw a stat in the analysis section that blew my mind. Manufacturing has a 77.63% weightage in India's industrial production index.
That is the forest view in a nutshell. If exports slump, manufacturing slumps. If manufacturing slumps, nearly 3/4 of India's industrial engine stalls.
Okay, so that's the high-altitude view. The engine is roaring, fueled by the U.S. and Africa, but you got these storm clouds with tariffs and, China.
A very volatile sky.
Now let's parachute down. Let's land in Vadodara, Gujarat. We have Shayona Engineering Ltd. opening their IPO. How does a company this size even fit into that massive global picture?
Shayona is basically the ground truth of those statistics. They're based in Vadodara, and the report notes that the western region, Gujarat and Maharashtra, accounts for nearly 40% of all those engineering exports we just talked about.
So they're geographically sitting right in the engine room.
They are.
And what do they actually do? I saw the term precision engineering in the prospectus. That can mean anything.
True. If I had to simplify it, think of them as tailors for factories.
Tailors for factories.
Yeah. They don't make the final car or the final ship that we discussed. They make these specialized custom metal parts that go into the machines that make those things.
Like the machine that makes the machine.
Exactly. They do casting, machining, heavy fabrication. They take raw steel and aluminum, the very commodities we discussed, and turn them into dies, molds, and parts for industrial automation.
And they also have that piping vertical.
Right, Shayona pipe. Dealing in HDPE and PVC pipes, which is basically the plumbing of industrial infrastructure. So they're feeding into two trends, the industrial machinery boom and the general infrastructure build-out happening across India.
Let's look at the deal itself. This is an SME IPO. For our listeners who usually only track the big main board listings, how is this different?
Well, the barrier to entry is significantly higher. You can't just buy 1 share or 10 shares. You have to buy a lot.
A lot.
And in this case, the lot size is 1,000 shares.
So at the upper price band of what, 144 BU per share, you're writing a check for roughly 1.44 lakhs minimum.
Yes, it filters out the casual retail investor who might just want to put in 10 or 15,000 rupees. And the total issue size is small, about 14.86 crore. But here's the green flag that caught my eye. It is 100% a fresh issue.
No offer for sale.
None.
Okay, let's explain why that matters so much.
So in many IPOs, you have an offer for sale, or OFS, which means the early investors or the founders are selling their shares to the public, they're cashing out.
Taking money off the table.
Right. In a fresh issue, the company is creating new shares to sell. That means the money you pay goes directly into the company's bank account to be used for growth.
So the promoters aren't buying a yacht, they're buying machinery.
Exactly. It usually signals that they believe the business can grow if it just had more capital.
But does the balance sheet justify that confidence? I looked at the growth numbers, and I have to say, They look suspiciously correlated to the export boom we just talked about.
They absolutely track. Look at the revenue jump from FY24 to FY25. They went from 15.28 crore to 23.18 crore,
That's a 52% spike in 1 year.
which aligns almost perfectly with that post-pandemic industrial surge we saw in the macro data. And they're profitable. Profit after tax rose from 1.71 crore to 2.42 crore.
And their margins.
Their EBITDA margins, essentially their operating profit, are sitting healthy at around 21%.
21% operating margin is decent for a manufacturing setup. It shows they aren't just churning volume. They have some pricing power.
And look at the asset column. By November 2025, their assets jumped to over 41 crore. That tells me they have already started investing in capacity. They're not waiting for the IPO money to start building.
They're already scaling. So let's talk about the price tag. They're asking for $17.44 per share. Is that expensive?
Well, let's look at the PE ratio price to earnings. Pre-IPO, it's around 17. Post-IPO, based on expected earnings, it drops to roughly 15.25.
And the industry average is what?
Usually hovers between 20 and 25 for this specific sector.
So 15 versus 25. That sounds like they're leaving some money on the table for investors. It's price attractively.
On paper, yes, it looks undervalued compared to its peers.
And here's the mystery that I can't quite figure out. I checked the gray market premium, the GMP, for today, January 22nd. It's zero.
Flat. Complete silence.
How do you reconcile that? You've got 52% growth, healthy margins, a valuation cheaper than the industry, and a booming sector. Why is the market giving it a collective shrug?
It's the SME liquidity trap. This is something every listener needs to understand before looking at these small companies.
Okay.
Investors know that once you buy into an SME IPO, getting out can be hard. The trading volumes are low.
You mean there might not be a buyer when you want to sell?
Exactly. So even if the company's great, the stock might not be liquid. A flat GMP doesn't mean the company is bad. It just means the market doesn't expect a speculative frenzy on day one. It's effectively saying, if you buy this, you're marrying it.
So it's not a lottery ticket, it's a long-term hold.
Precisely. And there are risks that might be keeping that hype down. We have to look at the vulnerabilities. The biggest one for me is customer concentration.
Right. For a company with 23 crore in revenue, they can't have that many clients.
They likely rely on a handful of big factories. If they lose one or two major contracts, that 52% growth we celebrated could reverse overnight.
And let's loop back to the Section 232 tariffs. Shayona buys steel and aluminum. If a trade war spikes global aluminum prices, what happens to that 21% margin?
It gets eaten alive. Unless they have contracts that let them pass those costs on immediately, raw material volatility is a massive risk. They're price takers, not price makers. When the elephants, the US and China, fight over tariffs, the ants, the SMEs, get trampled.
That is a sobering thought. So if we step back and look at the whole picture, the forest is growing out. Exports are hitting records, driven by the US. But the tree Shayona is exposed to the winds.
That is the perfect way to visualize it. The IPO proceeds are going toward new machinery. They are betting that the export demand will keep trickling down to Vadodara. They're expanding capacity to catch more of that rain.
But if the geopolitical weather changes, if those tariffs bite harder, or if US demand slows, Shayona is the first to feel the drought.
Small and medium enterprises are always the canaries in the coal mine. They feel the pain before the giants do.
So what's the verdict for the listener? We have the listing coming up tentatively on January 30th.
If you're looking for a quick listing pop to flip for a profit, the flat GMP is a flashing red light. The market isn't buzzing. But if you believe the EEPC report, if you believe the structural shift of manufacturing to India is a 5 to 10-year story, then getting in at a PE of 15 when the industry is at 25 is a value play.
It's a bet on the ecosystem, not just the company.
Correct. You are betting that the forest will protect the tree.
I want to leave our listeners with a thought that connects these two dots. We saw that ships and boats export number explode by 92%. We see Shayona expanding capacity for heavy fabrication.
Right.
As global supply chains continue to de-risk from China, we're seeing this localization of manufacturing power. But here's the question. Will these SME clusters in places like Gujarat become the new, resilient backbone of global supply chains? Or, in an era of reciprocal tariffs and trade wars, are they just collateral damage waiting to happen?
That is the big question. Are they the backbone, or are they the buffer that gets crushed when giants collide?
Something to mull over as you watch the ticker this week. It is going to be an interesting year for Indian engineering, and we will be here to track it.
Absolutely. Thanks for listening.
See you next time.